Every single banking crisis in modern history followed the same brutal pattern. First, the banks stop lending, then credit freezes, then asset prices collapse. Then millions of ordinary people wake up one morning and discover that the thing they thought was safe, the thing they trusted with their life savings, no longer exists. Gone. Wiped out. Zero. It happened in 1929. It happened in 2008. It happened in Cyprus in 2013 when they literally reached into people's bank accounts and took their money. And right now, at this very moment, the conditions that created every single one of those crises are not just present, they are worse than they have ever been in recorded financial history. $36 trillion in U.S. government debt, a banking system sitting on over $600 billion in unrealized losses. 3 major U.S. banks collapsed in a single week just last year. And the FDIC, the institution that is supposed to protect your deposits, has roughly 1 cent available for every dollar it insures. 1 cent. So here is the question that matters more than anything else in your financial life right now. If the next banking crisis hits, and the signals are screaming that it will, do you own the assets that survive? Or are you holding the ones that go to zero? In the next few minutes, I am going to show you 7 assets that have survived every banking crisis in history, and 5 assets that were completely destroyed. And by the end of this video, you will understand something that less than 1% of investors truly grasp: the difference between real wealth and the illusion of wealth. Let us start with the survivors. Right now, most people feel like something is wrong, but they cannot quite explain what it is. They see the stock market near all-time highs, and they are told the economy is fine. But then they go to the grocery store, and a bag of groceries costs twice what it did 4 years ago. They see their rent going up. They see credit card debt at record highs. They see car loan defaults surging. They see commercial real estate values collapsing, and regional banks quietly writing down billions in losses. The headlines say everything is fine, but the numbers say something very different. And here is the thing that makes this moment so dangerous. Most people have never lived through a real banking crisis. They do not know what it feels like. They do not know how fast it happens. They do not understand that the assets they think are safe, the ones sitting in their brokerage accounts and their retirement funds, many of those assets have a track record of going to absolute zero during systemic financial stress. But some assets do not go to zero. Some assets have survived not one crisis, not 2 crises, but every single banking crisis across centuries. And understanding which is which could be the most important financial knowledge you ever acquire. Here is what most people miss. It is not about picking the asset that goes up the most during good times. It is about owning the assets that do not disappear during the worst times. Survival first, profit second. That is how generational wealth is built. And that is what every banking crisis in history teaches us. Let me show you the 7 survivors, and the real mechanism behind why they survive. Survivor number 1, physical gold. Gold is not just a shiny metal. Gold is the only financial asset in human history that has never gone to zero. Not once. Not in 5,000 years. Think about that. Every currency ever created by every government in history has eventually gone to zero or been replaced. Every single one. The Roman denarius, the German papier mark, the Zimbabwean dollar, the Venezuelan bolivar, all of them, gone. But gold? Gold survived the fall of Rome. Gold survived the collapse of the British Empire. Gold survived the Great Depression. Gold survived the 2008 financial crisis. Gold survived every war, every hyperinflation, every banking panic in recorded history. And here is why. Gold has no counterparty risk. When you hold physical gold, no bank needs to honor a promise. No government needs to back it. No corporation needs to remain solvent. It simply is. It exists. It has value because humanity has agreed for 5 millennia that it has value. And that consensus has never broken. Not once. During the 2008 crisis, while banks were failing and stock portfolios were cut in half, gold rose from roughly $700 an ounce to over $1,900 an ounce within 3 years. During the banking panic of 2023, when Silicon Valley Bank and Signature Bank collapsed, gold surged past $2,000. Today it is trading above $2,300 an ounce. Central banks around the world bought over 1,000 tons of gold in both 2022 and 2023. The highest pace of central bank gold buying in decades. They are preparing. The question is whether you are. Survivor number 2, physical silver. Silver is gold's more volatile but equally resilient cousin. And in many ways, silver is even more interesting than gold during a banking crisis. Why? Because silver has dual demand. It is both a monetary metal and an industrial metal. Silver is used in solar panels, electronics, medical devices, electric vehicles, and military applications. Global silver demand has exceeded supply for 3 consecutive years. The Silver Institute reports a structural deficit of roughly 140 million ounces. That means the world is consuming more silver than it is mining, every single year, and above-ground inventories are being drawn down. During the 2008 crisis, silver initially dropped with everything else, but then it rocketed from under $9 an ounce to nearly $50 an ounce by 2011, a 500% move. And here is what makes silver particularly powerful right now. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting near 80. Historically, during monetary crises, this ratio compresses violently toward 30 or even 20. If gold holds its current price and the ratio reverts to 40, silver would need to trade near $60 an ounce. If gold goes higher and the ratio compresses further, we could see triple-digit silver. The setup is extraordinary. Survivor number 3, productive agricultural land. Here is a quote from Warren Buffett himself. He said that if you own a farm, you know it is going to produce food regardless of what happens in the banking system. Land does not go to zero. And productive agricultural land, land that grows food, is perhaps the most crisis-resistant asset class in existence. Why? Because people have to eat. That demand never goes away. Not during a depression, not during a banking crisis, not during a war, not ever. During the Great Depression, while stocks lost nearly 90% of their value and thousands of banks failed, farmland values declined only modestly and recovered faster than any financial asset. During the 2008 crisis, farmland values in the U.S. Midwest barely declined at all. In fact, they continued to rise through the crisis and into the recovery. Bill Gates is now the largest private owner of farmland in the United States, with over 270,000 acres. You think he does not see what is coming? Farmland generates income through crop production or leasing. It appreciates over time because they are not making more of it, and it provides a real, tangible hedge against both inflation and systemic financial collapse. Survivor number 4, energy assets and energy royalties. The world runs on energy. It ran on energy before the banking system existed, and it will run on energy if the banking system collapses. Oil, natural gas, and the infrastructure that delivers them do not go to zero during a banking crisis. They become more valuable. Because energy is essential, you need it to heat your home, you need it to transport food, you need it to run hospitals and factories and military operations. The demand for energy is inelastic. It does not disappear during a recession. It barely even declines. During the 2008 financial crisis, oil prices dropped temporarily but rebounded sharply because the world still needed every barrel. Energy companies with low-cost reserves and strong balance sheets survived and thrived. Energy royalty owners, people who own the mineral rights beneath producing wells, continued to receive monthly checks even while the banking system was imploding. They did not need a bank to honor a promise. They did not need a stock exchange to remain open. They owned a real asset that produced real income tied to real demand. And this is where everything changes for investors who understand the difference between financial assets and real assets. Financial assets depend on the system functioning. Real assets function regardless of the system. Survivor number 5, essential infrastructure. Water utilities, electrical grids, toll roads, pipelines. These assets survived every banking crisis in modern history because civilization depends on them. You can close the stock market, you can shut down the banks, but you cannot turn off the water supply. You cannot shut down the electrical grid. You cannot stop people from needing to move goods across the country. During the Great Depression, utility stocks were among the only equities that continued paying dividends. During the 2008 crisis, infrastructure-related investments significantly outperformed the broader market. The reason is simple. These assets generate revenue based on essential human needs, not on financial speculation or credit expansion. When the credit cycle turns and banks start failing, demand for speculative assets collapses. But demand for water, electricity, and transportation does not. Survivor number 6, short-term U.S. Treasury bills. Now this one might surprise you. I am not talking about long-duration Treasury bonds. Those can lose enormous value when interest rates rise, as we saw in 2022 when long-term Treasuries had their worst year in over 240 years. I am talking specifically about short-term Treasury bills, bills that mature in 1 month, 3 months, 6 months. Here is why they survive banking crises. During a systemic panic, capital floods into the shortest, safest instruments available. T-bills are backed by the full faith and credit of the US government. And while you can debate whether that faith and credit is as strong as it once was, during an acute banking crisis, T-bills become the ultimate parking spot for cash. During 2008, T-bill yields briefly went negative because so many people were piling into them. The demand for safety was so intense that investors were literally willing to pay the government to hold their money. T-bills will not make you rich, but during a banking crisis, their job is not to make you rich. Their job is to make sure your cash still exists when the storm passes. That is a job they have done without fail through every crisis in modern American history. Survivor number 7, Bitcoin. Now before you react, hear me out. I know Bitcoin is controversial. I know it is volatile. But Bitcoin has a unique characteristic that no other digital asset shares. It is the only cryptocurrency that has survived every major market crash, every regulatory assault, and every exchange collapse since its creation. Bitcoin was born during the 2008 financial crisis. Its Genesis block literally contains a newspaper headline about bank bailouts. It was designed specifically as an alternative to the banking system. During the 2020 pandemic crash, Bitcoin dropped and then surged to new all-time highs. During the 2022 crypto collapse, when FTX, Celsius, Voyager, and dozens of other crypto platforms went to zero, Bitcoin survived. It dropped, but it did not die. It is still here. It is still functioning. Every single block continues to be produced roughly every 10 minutes, just as it has since 2009. Here is the key distinction. Bitcoin is not the same as crypto. Most crypto tokens are speculative garbage with no fundamental value. Bitcoin is a decentralized, fixed supply, censorship-resistant monetary network. It has a hard cap of 21 million coins that can never be changed. No government can print more of it. No bank can freeze it. No exchange collapse can destroy the network itself. Is it volatile? Absolutely. Is it risky? Yes. But has it survived every crisis thrown at it? So far, the answer is yes. And for a growing number of investors and institutions around the world, that track record matters. Bitcoin is the youngest asset on this list, but its survival record in its short life has been remarkable. Now here's the part that most people are not prepared to hear. Let us talk about the 5 assets that went to zero. The assets that millions of people trusted with their life savings. The assets that looked safe right up until the moment they were not. Zero number 1. Bank deposits above the insurance limit. Most Americans believe their bank deposits are safe, and up to $250,000 per depositor per bank, the FDIC does provide insurance. But here is what most people do not know. The FDIC insurance fund contains roughly $128 billion. Total insured deposits in the U.S. banking system exceed roughly $10 trillion. That is coverage of approximately 1.2%. In a systemic crisis where multiple large banks fail simultaneously, the FDIC does not have the money. In Cyprus in 2013, the government imposed a bail-in. Depositors with over 100,000 euros in their accounts had up to 47.5% of their money confiscated. Not taxed, confiscated, taken directly from their accounts to recapitalize the failing banks. The European Union praised it as a template for future banking crises. In other words, they told you they plan to do it again. And if you think it cannot happen in the United States, I would encourage you to read the Dodd-Frank Act very carefully. The bail-in provisions are already in the law. Zero number 2. Long-term corporate bonds of failing institutions. When Lehman Brothers collapsed in September 2008, its corporate bonds went to essentially zero overnight. Billions of dollars in bonds that were rated investment grade just months earlier became worthless pieces of paper. The same happened with Washington Mutual bonds. The same happened with Bear Stearns bonds. The same happened with Enron bonds years earlier. Here is the mechanism. Corporate bonds are a promise by a corporation to pay you back with interest. But a promise is only as good as the entity making it. When a bank or a corporation fails, bondholders often receive pennies on the dollar, or nothing at all. And here is the terrifying part. Many retirement funds, pension funds, and so-called conservative portfolios are loaded with corporate bonds. Investors hold them because they were told bonds are safe. But bonds are not safe. They are promises, and promises can be broken. Zero number 3. Shares in failing banks. This one seems obvious in hindsight, but in the moment, it catches millions of investors by surprise every single time. When Bear Stearns collapsed in 2008, its stock went from over $150 per share to $2 per share in a matter of days. Lehman Brothers stock went to zero. Washington Mutual stock went to zero. In 2023, Silicon Valley Bank stock went from over $260 to zero in 48 hours. First Republic Bank stock went from over $120 to zero. Here is what most people miss. These were not penny stocks. These were not speculative gambles. These were major regulated financial institutions. They were in the S&P 500. They were held in index funds. They were recommended by analysts, and they went to zero. If you owned an index fund that held these banks, you took losses. If you owned these banks directly in your retirement account, you were devastated. The lesson is brutal but simple. Bank stocks are not safe assets. They are leveraged bets on the credit cycle, and when the credit cycle turns, they can and do go to zero. Zero number 4. Money market funds that break the buck. In September 2008, the Reserve Primary Fund, one of the oldest and largest money market funds in the United States, broke the buck. The net asset value of the fund fell below $1 per share. Investors who thought their money was as safe as cash suddenly discovered they could not withdraw their funds. The fund was frozen. Redemptions were suspended. It took years for investors to get most of their money back. Most of it. Not all of it. Money market funds are marketed as cash equivalents, but they are not cash. They are pools of short-term debt instruments, including commercial paper from corporations and banks. When those corporations and banks get into trouble, the underlying assets of the money market fund lose value. And when investors panic and try to withdraw simultaneously, the fund cannot meet redemptions. It freezes. Your money is trapped. This happened in 2008, and the structural risks have not been eliminated. They have been papered over with regulations that ironically give fund managers the legal authority to suspend redemptions during periods of stress. Think about that. The rules now explicitly allow them to lock you out of your own money. Zero number 5. Crypto tokens and exchange-held assets. This is the most recent and perhaps most devastating example. In November 2022, FTX, one of the largest cryptocurrency exchanges in the world, collapsed virtually overnight. Over $8 billion in customer funds vanished. Customers who held their crypto on the FTX exchange lost everything. Not because cryptocurrency itself failed, but because they trusted a centralized intermediary with their assets. The same pattern played out with Celsius, Voyager, BlockFi, and dozens of other crypto platforms. The lesson here is not that digital assets are inherently worthless. The lesson is that counterparty risk can destroy any asset, no matter how promising, if you do not actually control it. If you hold crypto on an exchange, you do not own crypto. You own a promise from that exchange to give you crypto when you ask for it, and when the exchange fails, that promise goes to zero. This is the same lesson that bank depositors learned in Cyprus, the same lesson that Lehman bondholders learned in 2008, the same lesson that money market fund investors learned when the Reserve Primary Fund broke the buck. If you do not hold it, you do not own it. And this brings us to the most important pattern in this entire video. Look at the assets that survived: gold, silver, farmland, energy, infrastructure, T-bills, Bitcoin. What do they all have in common? They are either tangible physical assets, or they are assets with no counterparty risk or minimal counterparty risk. They do not depend on a bank remaining solvent. They do not depend on a corporation keeping its promise. They do not depend on an exchange staying open. They exist independently of the financial system. Now look at the assets that went to zero. Bank deposits above the insurance limit, corporate bonds, bank stocks, money market funds, exchange-held crypto. What do they have in common? Every single one of them depended on someone else keeping a promise. A bank promising to hold your deposits, a corporation promising to repay its bonds, an exchange promising to custody your assets. When the crisis hits, when the stress becomes systemic, promises break, and the assets built on those promises break with them. History shows this pattern again and again. It is not a theory, it is not a prediction. It is a documented, repeated, proven pattern across centuries of financial history. So why does this time feel different? Why does this moment feel more urgent than previous cycles? Because the scale of the imbalances is unprecedented. U.S. government debt is $36 trillion and growing at $1 trillion every 100 days. the Federal Reserve's balance sheet is still bloated at nearly $8 trillion. U.S. commercial banks are sitting on over $600 billion in unrealized losses on their bond portfolios. Commercial real estate values are cratering, and regional banks hold the majority of those loans. Consumer credit card debt has surpassed $1.1 trillion. Auto loan delinquencies are at their highest level since 2008. And the global derivatives market, the shadow financial system that connects every major bank in the world, is estimated at over $600 trillion in notional value. $600 trillion. That is roughly 6 times the entire global GDP. The system is not just fragile, it is a powder keg, and the fuse is getting shorter. Now here are the key indicators you should be watching. First, watch the Federal Reserve's emergency lending facilities. During 2023, the Fed created the Bank Term Funding Program to quietly bail out banks with underwater bond portfolios. If new emergency facilities are announced or existing ones are expanded, that tells you the stress is intensifying behind the scenes. Second, watch the yield curve. Specifically, watch when it uninverts. Historically, the recession and the banking crisis do not start when the yield curve inverts. They start when the yield curve steepens back to normal. That steepening is happening right now. Third, watch credit spreads. The difference between corporate bond yields and treasury yields. When credit spreads start widening rapidly, it means the bond market is pricing in rising default risk. That is one of the most reliable leading indicators of systemic financial stress. Fourth, watch the gold price. When gold makes sustained new all-time highs, especially when driven by central bank buying and physical demand rather than speculative futures trading, it tells you that the institutions that understand the system best are preparing for its failure. Here is the bottom line. The next banking crisis is not a matter of if, it is a matter of when. The structural conditions are already in place. The imbalances are already larger than they were before 2008. The warning signs are already flashing. And when it hits, the same pattern that has played out across centuries will play out again. Assets built on promises will break. Assets with no counterparty risk will survive. And the gap between those who prepared and those who did not will be the widest it has ever been. You do not get to choose whether the crisis comes, but you do get to choose which assets you are holding when it arrives. 7 assets have survived every banking crisis in history. 5 have gone to zero. Now you know which is which. What you do with that knowledge is up to you. If you want more deep market analysis like this, subscribe and stay close to the channel. The signals are there for anyone willing to look. But the window to act is not open forever.